Stop assuming your book of business is safe. Because independent insurance agencies are failing right now at a rate the industry doesn't like to talk about, and it's not because agents are bad at their jobs. It's because the entire model was built on a foundation that's cracking in 3 places at once: carrier dependency, commission compression, and a succession crisis almost nobody planned for. We are breaking down the real math behind why most independent insurance agencies are quietly failing, even the ones that look profitable on paper. And I want to say upfront why this one is different from a lot of the businesses we've broken down on this channel. Independent insurance agencies aren't thin margin businesses. A well-run agency can post healthy operating margins, commonly 15 to 25%, which is genuinely good. So this isn't a story about razor-thin economics grinding you down every month. This is a story about a business that can look completely fine on the income statement right up until the moment one specific risk hits. And when it hits, it doesn't just dent your year. It can unwind a decade of work in a single renewal cycle. Let's build the actual model. Part 1. The concentration risk nobody underwrites. For here's the thing independent agencies sell every single day without saying it out loud: diversification. That's the entire pitch to the client. You're independent, you're not locked into one carrier, you can shop the market, you protect the client from any single insurance company's bad decisions. It's a good pitch. It's also almost never true about the agency's own business. In reality, most independent agencies carry heavy concentration with a small number of carrier partnerships. It's common for 2 or 3 carriers to represent the majority of an agency's written premium. Sometimes 60, 70, even 80% of the book sitting with just a handful of markets. That concentration isn't an accident. It happens because building a strong relationship with a carrier, getting better contingency terms, faster underwriting turnaround, broader appetite, takes years. And agencies naturally consolidate volume with the partners who treat them best. It's rational behavior at the individual level. It's also exactly the kind of concentration risk the agency would flag immediately if a client's investment portfolio looked the same way. And here's why that concentration has become genuinely dangerous in the current environment. Carriers are pulling back appetite, particularly in property lines, particularly in states with elevated catastrophe exposure, faster and more aggressively than at almost any point in recent memory. Rising reinsurance costs, worsening loss experience from severe weather, and tightening capital requirements are pushing carriers to non-renew entire blocks of business, restrict new business in certain zip codes, or exit specific states outright. When that carrier represents 20, 30, 40% of your book, that's not a bad quarter. That's an existential event, and it can happen with a notice period measured in months, not years. Part 2. The commission compression. Now layer in what's happening to the revenue side of this business. Because even before a carrier pulls out entirely, the terms of the relationship have been quietly getting worse. Standard property and casualty commissions for independent agents commonly run in the 10 to 15% range on written premium. And that number has faced steady downward pressure for years, as carriers push more of the profitability burden onto contingency and bonus commissions instead of guaranteed base commission. That sounds like a technical distinction, but it changes the entire risk profile of your revenue. A guaranteed base commission is money you can plan around. A contingency bonus is money you only get if you hit specific loss ratio and growth targets set by the carrier. Targets that get harder to hit precisely in the years when catastrophe losses are elevated, which, not coincidentally, is exactly when agencies need that revenue the most. Think about what that structure actually does. In a bad loss year, a hurricane season, a wildfire season, a hailstorm that tears through your territory, your clients are filing more claims, which is exactly what insurance is supposed to do. But that same bad loss year is what pushes your book's loss ratio outside the carrier's target range, which is what disqualifies you from the contingency bonus you were counting on. You get punished on the revenue side in precisely the years when your clients need you to have shown up for them the most. The commission structure and the actual purpose of the business are pulling in opposite directions in exactly the moments that matter. Part 3. The forced remarketing mathlet. Let's put real numbers on what happens when a concentrated carrier relationship actually breaks. Because this is where the theoretical risk becomes a real dollar loss. Model an agency generating $1 million in annual commission revenue. Carrier concentration being what it commonly is, let's say $200,000 of that, 20%, sits with a single carrier that decides to non-renew an entire segment of business. Say every property policy in a specific coastal region. Here's what happens next. You don't just lose that carrier relationship. You have to remarket every single one of those policies to different carriers, under different terms, often at different price points, on a timeline the carrier sets, not you. And forced remarketing has a real measurable retention cost. Clients who get a non-renewal notice on their homeowner's policy don't calmly wait for their agent to solve it. Plenty of them start shopping immediately. Some go directly to carriers, some go to competing agencies. Some simply can't find comparable coverage at a comparable price and have to make hard decisions about their coverage that sour the relationship regardless of how well you handle it. Retention rates during a forced remarketing event commonly run meaningfully below normal renewal retention. Normal renewal retention for a healthy agency might sit in the low 90s%, while forced remarketing retention can drop into the 60 to 75% range, depending on how disrupted the local market is. Let's say you retain 70% of that affected book through the remarketing process. That's a real loss of $60,000 in annual commission revenue. 30% of that $200,000 segment gone, not because you did anything wrong, but because the carrier made a capital allocation decision in a boardroom that had nothing to do with your agency specifically. Now measure that against the model we're about to build, because $60,000 sounds survivable in isolation. It's what it represents as a share of your actual profit that makes it dangerous. Part 4. The full year. Model build the whole picture in dollars, starting from that same $1 million commission revenue. Producer and staff compensation is the largest expense in almost every agency. Commissioned producers, salaried customer service representatives, account managers, commonly running 50 to 55% of revenue. Call it 52%, $500 to $20,000. Rent and overhead for office space, utilities, and general operations commonly runs 8%, $80,000. Errors and omissions insurance, plus the agency management system and other required technology, commonly runs 7%, $70,000. And that number has been climbing as E&O premiums rise industry-wide, along with claims activity. Marketing and client acquisition costs commonly run 5%, $50,000. Everything else, professional fees, licensing, continuing education, general administrative costs, call it 8%, $80,000. Add it up, 52, 8, 7, 5, 8. That's 80% of revenue, $200,000 in operating costs. On $1 million in commission revenue, that leaves $200,000, a genuinely healthy 20% operating margin. This is why independent insurance agencies don't look like a wealth destroyer on a normal year. $200,000 of margin is real money. And it's exactly what makes this business attractive enough that people keep buying into it. Now apply the $60,000 loss from the forced remarketing event we just modeled. That's not $60,000 off a $1 million top line. That's $60,000 off a $200,000 profit line. In one non-renewal event, on one carrier relationship, you just lost 30% of your entire annual profit. And that's the moderate scenario. A single carrier pulling back on a single segment. Agencies with heavier concentration, or operating in states seeing broader market withdrawal across multiple carriers at once, are seeing this exact mechanism compound 2 and 3 times in the same renewal cycle. This is the number that explains why an agency can look financially healthy for years, and then have a genuinely brutal 18 months. The margin was never the problem. The concentration sitting underneath a margin that looked fine was the problem the whole time. Part 5. The perpetuation crisis. Now, let's talk about the threat that isn't about any single bad year at all. It's about what happens at the end. Because this is the one almost nobody in this industry wants to say out loud. Independent insurance agency ownership skews significantly older than most small business sectors. And a large share of agency principals are sitting within striking distance of retirement age without a completed succession plan. That's not a minor administrative gap. An insurance agency's entire value is built on the relationship between the owner, the staff, and the client base, and when there's no clear plan for who takes over those relationships, the agency's value doesn't sit there waiting patiently for the owner to figure it out. It erodes quietly every year the plan doesn't exist. Here's the math on why that erosion is so costly. A well-run, well-documented agency with clean books, diversified carrier relationships, and a clear management structure can commonly command a sale price in the range of 1.5 to 2.5 times annual revenue, or roughly 6 to 8 times EBITDA from a serious buyer. On our model agency, doing $1 million in revenue and $200,000 in profit. That's a business potentially worth $1.5 to $2.5 million to the right buyer under the right conditions. But an agency without a succession plan, without documented processes, with client relationships concentrated entirely in the owner's personal network, rather than the agency's institutional relationships, doesn't sell at that multiple. It sells at a steep discount, if it sells at all, because the buyer is inheriting all of the concentration risk and commission compression we just walked through, with none of the systems in place to manage it, and often with a retiring owner who represents the actual client relationships walking out the door at closing. Decades of built value can evaporate down to a fraction of what the same revenue and profit would have commanded with a real plan in place. And unlike the carrier non-renewal risk, this one doesn't announce itself with a notice letter. It just quietly happens, year after year, until the owner is ready to retire and discovers the exit they assumed was there isn't. Part 6. The consolidation trap end. Here's the pressure making all of this worse at the same time. Private equity-backed consolidators have been aggressively acquiring independent agencies for years now, and that changes the competitive landscape. For everyone still standing independently, these consolidators can offer things a standalone independent agency structurally cannot: broader carrier access from sheer scale, shared technology and marketing infrastructure, and centralized back-office efficiency that spreads costs across dozens or hundreds of locations instead of one. That means the independent agency down the street isn't just competing against other independents anymore. It's competing for carrier appointments, for producer talent, and for client acquisition against consolidated groups with a fundamentally different cost, structure, and a fundamentally better negotiating position with carriers. This creates a genuinely uncomfortable dynamic for agency owners. The same consolidation wave that's squeezing independent agencies competitively is also the primary buyer showing up when an owner finally does want to sell, meaning many owners face a choice between selling into the consolidation wave on the buyer's terms, often earlier and cheaper than they'd planned, or staying independent and competing against increasingly well-capitalized consolidated competitors with structurally better economics. Neither option is the version of building something that's yours that most people had in mind when they got into this business. All is the final verdict, so here's where this actually lands. Independent insurance agencies aren't failing because the margins are too thin. We just showed you they're not. They're failing because a genuinely good-looking 20% operating margin is sitting directly on top of 3 compounding risks that don't show up on a normal income statement. Carrier concentration that can erase 30% of your annual profit in a single non-renewal event. A commission structure that pays you least in the exact years your clients need you most. And a succession and consolidation environment that can quietly destroy decades of built equity by the time you're ready to cash out. None of these 3 threats, on their own, is necessarily fatal. A well-managed agency can diversify its carrier relationships deliberately instead of by accident. It can build a real succession plan a decade before it's needed instead of a year after it's too late. It can decide proactively whether to sell into consolidation on its own timeline or build the scale to compete with it, instead of having that decision forced by a crisis. The agencies quietly failing right now are, almost without exception, the ones that never ran this version of the math. They looked at a healthy income statement, assumed healthy, mint safe, and never modeled what a single concentrated carrier relationship, an uncompleted succession plan, or a well-capitalized consolidator moving into their territory would actually do to the business they spent 20 years building. If you're running an agency right now, this is the actual audit to run, not is my income statement healthy this year, but what percentage of my book sits with my 2 largest carriers? What happens to my profit if the smaller of those 2 non-renews a segment next year? And who is actually positioned to run this agency if I'm not here to run it myself? If you haven't run that version of the math, a healthy income statement isn't telling you what you think it's telling you. If you're in this industry right now, or thinking about starting or buying an agency, I want to hear where you land. Drop it in the comments. And if you want the follow-up on what a real carrier diversification and succession plan actually looks like in practice, let me know, because agencies that get ahead of this do exist. They're just not the majority. And that's exactly the problem.